Hello everybody, welcome to this King & Shaxton Asset Management first quarter review. My name's Harry Thompson, I'm a portfolio manager at King & Shaxton. I'll be running you through today's slides. As mentioned, this is for the first quarter and it was an incredibly volatile quarter. There's plenty of points to discuss, both from a market point of view as well as an ESG point of view. The new year began very much to cue with the global economy reflating. The main concern for markets being how fast and how hard central banks were going to tighten monetary policy with interest rate hikes and tapering. Whilst the economic recovery appeared textbook, the extent of growing supply chain issues with essential goods, transportation bottlenecks, and labour shortages were not. Each of these were adding fuel to the already blazing inflation fire, and in the first half of the quarter, interest rate expectations rapidly heated up. This in turn hit both bond markets and growth-focused equities hard, with many equity indices falling around 10% by the middle of the quarter. The only exception in equities were sectors that underperformed during the COVID crisis, including banks, mining, and oil and gas companies. Sectors with a strong ESG and impact profile, which had a higher growth exposure, tended to suffer more in the first part of the quarter. This was visible when looking at an array of market indices, which showed very different performance numbers. It was also a frustrating start to the quarter, as the reflation trend of 2021 continued with momentum rather than abate as anticipated. In early February, events in Central Europe began to cause concern. The build-up of Russian forces on the Ukrainian border was alarming, but the tragedy that soon unfolded was even more of a concern, and not just for financial markets. Putting aside the appalling human cost of war, it is often said the first casualty is truth. Whilst this is true on one level, at a deeper level, war reveals longer running truths and fault lines in society, and I'll touch more on this in the next slide. Fixed income fell in the quarter despite the safe haven flows seen at the end of February as Russia invaded Ukraine, highlighted with the red circle. Nonetheless, the asset class finished the quarter lower as the hawkish central bank rhetoric continued. As an asset class, we have been negative on it for a number of years. In our view, we are reaching the point where we are close to overpricing future interest rates. As a result, this sector has become more interesting, and over the quarter we added to fixed income exposure. The near-term risks with fixed income are still around tapering, and increasingly, credit quality, as things become more strained. So our focus has been on quality of the debt and the underlying business. Within property, our exposure has been stable and is more defensive in nature, as seen by the chart which shows PRS right and home right relatively flat over the period. We remain exclusively focused on investments with a strong social impact, such as medical property, housing for the homeless, or social housing for those with particular care requirements. However, as seen from the declining orange line, social housing has seen a little pressure as the sector remains under the regulator's spotlight and terms for new agreements have become a little more onerous. This was something that was expected. There was no major changes to our property exposure during the quarter. In a similar vein, the more defensive infrastructure-focused equities performed well in the quarter. These holdings are typically owners and operators of renewable assets such as wind farms, but also other technologies such as energy storage. Higher wholesale prices for electricity help sentiment, even though much of the business is on long-term contracts. As interest rate expectations began to fall back and sectors such as renewable energy returned to favour, we have seen a recovery from mid-quarter lows. We did anticipate volatility in our last report, but not quite the extremes we have seen. Global equity markets finished about 5% lower for the quarter, but this number hides a diverse range of returns depending on sectors and prospects, as well as general market movements within the month. The more impact-focused equities suffered due to their longer duration cash flows, although they bounced back as rate hike expectations eased in the face of the Ukraine and Russia conflict. The heightened volatility did create a number of investment opportunities, and in bespoke portfolios we added exposure in areas such as clean mobility. The attempt by Russia to invade and conquer Ukraine has dominated the headlines and has laid bare a number of key ESG fault lines that need to be addressed. To begin with, we'd like to clarify that our bespoke and model portfolios have no direct exposure to Russian investments. Both the Russian economy and its equity and bond markets are dominated by mining, large banks and oil and gas, sectors we avoid as investors. From a social perspective, we have also regarded Russia as an oppressive regime for some time and consequently saw no value in their banks or other assets. In some cases, there was indirect exposure, for example, where Russian timber was imported for sustainable packaging. But where this was held in bespoke portfolios, this has now been removed. Corporate behaviour since the war began has been very revealing. This has included some pleasant surprises, such as BP's rapid action to divest its stake in Rosneft at a high cost, as well as some disappointments from companies who have either been very slow or reluctant to take any action. Most notable is Europe's overdependence on Russian oil and gas. Being the cheapest in financial terms, this over-reliance now has high social costs for millions, which comes on top of the environmental costs that are already well documented. Germany was on the brink of expanding gas imports from Russia through Nord Stream 2, but now needs alternative sources of energy. Nord Stream 1 is still running at full capacity and Germany is hostage to Russia. We commented on this dependency in January, as Russia was already slowing deliveries. Whilst governments have long ignored the environmental costs of this policy, the social cost is proving harder to ignore. In 2016, we attended an UCSIF conference in Edinburgh, where the speaker was Leif Werner, who had just published his book Blood Oil: Tyrants, Violence, and the Rules That Run the World. The book served as a good reminder of the social considerations that also need to be factored in when looking at fossil fuels and other resources, not just the environmental factors that are easier to quantify. There are other areas with an immediate economic impact. The European car sector's dependence on Ukrainian components, the UK's financial and legal involvement with Russian oligarchs, and the world's exposure to Russian copper and nickel will add to supply chain worries and costs. Of even greater significance from a social perspective is the possible loss of exports of Ukrainian and Russian wheat. It will be felt in most developed economies with price rises, but the adverse impact will be felt much harder in the developing world, where it is a staple rather than a discretionary commodity. Whilst we knew the pandemic would change the world, the events over the last 6 weeks have added to this tension. Anyone old enough to remember the Cold War will also remember the peace dividend that followed. Defence spending fell sharply and state finances were diverted to other areas. We have already seen Germany double its defence spending, and in what were already difficult times, this will have ramifications as funds are diverted from other areas. At around the same time, the Japanese art of just-in-time manufacturing became fashionable. Globalization of supply chains made them tighter and leaner, so business and consumers became used to cheaper goods being just a click away. Before the pandemic, we saw some questioning of this, and the post-pandemic world, followed by conflict, has tested this to destruction. Nearshoring, local production, and sources of energy are now being considered in a broader context. There are some positive social and environmental benefits to this, but it will be inflationary in both the short and longer term. Whilst fossil fuels enjoyed a boom as both a beneficiary of global reflation and then furthermore from the sanctions placed on Russia, it has also sped up the desire for renewable energy on a global scale. The wider benefits of independence and localized production of renewable energy are increasingly apparent. In the short term, this will be inflationary, but going back to the past is no longer an option. Looking ahead, and as mentioned above, we may be heading towards more embedded mid and long-term inflation, on top of the short-term higher cost-push inflation we're already seeing at a time when economic growth is threatened. Interest rates may still need to rise a little, as are taxes in many leading economies, and whilst this will reduce demand pull inflation, we expect the cost-push inflation to persist. Whilst the ideal is that inflation pulls back and settles at 2 to 3%, there remains many risks and we do not see this scenario in the short term. The interest rate outlook is still for further rises. The UK economy has just seen a tax increase for working adults, and energy prices are beginning to impact households. The next 3 months contain a great deal of uncertainty, and the rate of economic growth is less certain. Social as well as physical infrastructure needs to change for the new world, and this favours many sectors we invest. And balancing this with wider macroeconomic concerns will be our focus in the next quarter. Thank you for listening to this first quarter fund manager review. If you do have any questions, please contact your King & Saxon representative and we'll be happy to answer any questions you may have. Thank you very much.